I actually really like trading index funds, but I don't invest in index funds the same way. And the reason why is because when you look at 10 plus years, I have no indication to feel very confident that that's going to produce a meaningful return. I view risk as the framework, right? That risk is like energy. You can't create it. You can't destroy it. You can only convert it, right? So you always have the net same amount of risk. It's just what risks are you willing to take on? And by typically hedging off or eliminating a risk or minimizing a risk, you're adding kind of an equal amount of a different type of risk.
Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
I think the framework I'm trying to build around and communicate to people, so it's like simplistic to try to understand, is like, hey, there's 5 asset classes to be invested in to sort of like hedge off this debasement risk over the whole market cycle. And it's high quality residential real estate, large cap US stocks, precious metals, Bitcoin, and liquid alternatives. Right, like non-correlated alternatives. And so like they'll all be able to sort of manage those markets, but they're all going to probably take different paths at different times in the sub cycles within this super cycle. So you still get some benefits of the diversification, and they each have their own unique components. But then like what you say is like, well, that's still a long-term cycle. So you can't just go and say like, well, I'm going to put all my money, right? If it's a 10-year cycle and you're trying to retire in years 3, like your first year of retirement is like year 3 of that cycle. You can't just go like, I'm putting it all in S&P 500 and gold, or, like you got to have
the 90-10 portfolio, the Buffett portfolio. Just give me 10% treasuries and 90% S&P.
Well, so I like the way that I distill it down is like, you might not want bonds because you're in this debasement cycle, right? So like, I am not somebody that I don't own any egg. I've never owned egg. I think egg is like a really stupid position for retail investors to like have in their portfolio, right? But all 5 of those other asset classes, like all 5 of those other assets largely, with maybe the exception of like some of the liquid alternative stuff, is they're Ponzi finance, right? It's like, it's exogenous return profiles. And it's like what Howard Marks said. It's like that speculative. You're simply buying an asset, like not because of its discounted cash flows and its intrinsic value. It's because you expect somebody's going to buy it from you for more dollars in the future than you're buying it for $1 today. Like that's it, right? And so I think like S&P or like large cap US stock is already so far disconnected from reality that it's like, you don't look at the S&P 500 and be like, oh, fair value is, 6,400. We're a little overvalued. Like we're so far disconnected. You know what I mean? Like if you look at it from like a value perspective, and so there's no intrinsic value. Like I think we're beyond like the intrinsic value conversation, and it's exogenous returns, right? However, stuff that is income focused is still endogenous return to the investment itself, right? Like there's that income sort of perspective. And so I think like the role that income plays in portfolios is kind of following that Kitsy like tent idea. Hey,
yeah, the bond tent.
Yeah, the bond tent. But
I think I've been thinking about this more and more, Brandon, just in terms of like structuring the portfolio for retirement for our clients. It's like the difference between financial assets and real assets or hard assets. And I mean, we're talking about, some of the people in the industry, they run the Monte Carlo analysis and they say, well, based on 10,000 simulations, 9,700 times out of 10,000, you're going to be fine. But then to say that to a client and say, well, 300 times it didn't work out, but you should be fine. It's like there's still such a huge disconnect there. And
well, like
I think there's value in that approach, but we do have to take an approach where we build up, where is the income coming from? How are we protecting it? And how are we going to protect against that worst case scenario that we are retiring into one of these periods that we're going to look back on and go, wow, that was crazy.
I think the income thing is interesting because you can't like, I think if you just look, if you go to that and say, okay, we're going to build like the bond tent,
Yeah.
you could get smoked getting like ag or picking up traditional like bond because
if inflation just runs away.
Well, just debasement in general. I just, it really, I think you kind of get smoked even if inflation stays kind of where it's at. You
just buying a cup of coffee now. It's like, yeah, I'm looking at that and saying, okay, a medium cup of coffee is almost $5.
Well,
it makes no sense.
I wrote on Twitter this morning. I talked about this like trader around gold and hard assets, and what I kind of had come up with really quick is like a way to explain this is like the reason most people have bonds in their portfolio is that their primary purpose is to protect purchasing power plus get us an additional little yield, right? So it's like purchasing power plus protection. Thinking tips, basically, you know what I mean? It's kind of the idea. But because of, duration risk or whatever, like there's different ways that that's going to manifest it. But generally, that's like the primary idea of having bonds, right? Like you want to have your cash back in the future with the same purchasing power, plus a little bit of risk compensation for taking the risk of borrowing it out to somebody in the meantime, right? Like that's generally bonds. The second layer, the second idea is that people want it for diversification. Historically, for the last 30, 40 years, like it's been a great diversifier. When stocks down, bonds up, great idea, increases your efficiency, decreases your risk significantly. In 2022, I think it fundamentally changed. And really, I think it fundamentally changed post-COVID in general. But, and then the third component is like this endogenous return profile, right? Like the income to the portfolio. So whether or not the markets trade sideways, you're sort of getting this yield in return. It's what's made T-bills such a great trade for a couple of years on this idea. But as that yield goes down, you can't really rely on that the same way of getting that risk-free yield that's a positive real return. And so I think like that's where people are starting to shift towards like the hard assets, the gold. I mean, Morgan Stanley, I think it was this last week, came out and said like, 20% gold allocation is what they're recommending now. And it's because like you get the protection of purchasing power, like goal number one. And if you're capital efficient, if you're on the institutional side, like there's ways to maybe like pledge it and get a little bit of yield on the gold actually. So then you kind of get that effect. You get the diversification effect because of the, now somewhat negative correlation, to, stocks. And, obviously gold has kind of always been a diversifier in portfolios. And then the third one though is like, and that's where gold is lacking, is it doesn't have that endogenous return, right? Like it just is never going to have that intrinsic value of a contract that like a bond would have, right? Like there's not a measurable cash flow. And that's where I think the gap is in the whole like debasement trade is you still have to look at a portfolio as you transition to retirement and say, okay, we still have to go have something that produces some kind of yield so that in the event this is the period through, a 10-year cycle, I'm retiring in year 3 or 4, but in year, 4 or 5 is when the market in that large cycle of it just exploding is still down 20%. And I don't want to be selling my assets at this.
We got to have something to fund lifestyle expenses and things like that. Yeah.
You got to smooth out that return in those couple of.
And gold is one of those things where, people have such strong feelings about it. Mm-hmm. You have the gold bugs, you have people that are more skeptical about it, but it has been around for thousands of years and it is a medium of exchange. And you do have central banks around the world buying it and actually storing it in vaults. Yeah. I do want to revisit, I don't know, was it earlier this year we had on Twitter, it was, hey, let's go into Fort Knox and see if the gold is there. That kind of fizzled out, right? Is it? Oh, yeah. Are they still going to do that?
I doubt it. I don't think they ever will. I actually, I probably don't need to get. I drove past it this summer. I drove past Fort Knox this summer, and I took a picture and was like texting people like, "You think it's in there or not?" And go
knock on the door, see if they'll let you in for a tour.
Yeah, this is like going to sound like very Spaceballsy, but my father-in-law's wife's father used to be like the command sergeant major at Fort Knox, and.
What's the relation?
My father-in-law's wife's father.
Okay.
So, anyways, yeah. And so we were out there. We had just driven by. We were over at his house, and I just asked him like, "Hey, Fort Knox, you think the gold's there or not?" And he's like, "No." And I'm like, "Whoa!" and he's like, "I think they moved it." you know, and I'm like,
you heard it here first.
and I'm like, oh, okay, well, yeah. So I mean, I don't think he kind of was alluding that, you know, he doesn't really necessarily have an educated opinion. He's like, I mean, he's been retired since like I think like the 80s, you know,
this is breaking news though.
But,
Heard it here first. This is going to get picked up on all the media outlets, I have a feeling.
Yeah.
So we might have to cut that.
I'm not a conspiracy theorist,
national
but it's
security.
You know, so here's the thing about gold though. Like, okay, so I last week in New York had the chance to be surrounded by a bunch of really intelligent people and chose to use my time Thursday night last week debating with a number of portfolio managers and people in a hotel lobby until midnight. And, you know, like there's this one individual that I was really having some discourse with, and it was a super fun conversation. Like it was all very friendly. But you know, he's the portfolio manager of about an $8 billion firm. And, you know, and he's like, gold is just like, I can't figure it out because it has no value. There's like basically no value to gold. And, you know, he's like, just, it's so stupid. You know, it's basically his argument. And I'm like, yes, but like, unless you're an absolute like deep value investor, like to the max, like the most pure deep value investor, then it's hard for you to have like stand on a leg and say, well, there's, you know, I'm not going to participate in this historic.
There's an element
it's
to
like,
that. I think there's an element to that with every asset. I think my question is with gold is, you know, it's, I never really understood the Bitcoin is digital gold argument until recently. There was a forum posting on NAPFA, and someone said, hey, I've got this client. They've got this physical Bitcoin that they've held since, you know, whenever the paper was released.
Yeah.
And it's actual one Bitcoin. And he was like, where can I sell this? And then my first thought was, oh, there's probably a premium associated with this because it's kind of collectible, right? And it's associated with that period of time. And then I thought to myself, well, if it was a gold coin, it was a US mint coin, it would also have a premium instead of just spot gold. So I was like, oh, it's the same. That's like the same thing, isn't it? So it was kind of this realization for me. I was like, oh, that.
I think it's one of those things. It's like it's like the 80-20 rule a little bit. Like it explains the relationship 80% of the way. And you know, how much value do you pick up in understanding the nuance of the 20? Maybe like the difference is there may or may not be a lot of alpha in that last 20%, but the effort to understand the last 20% is 80% of the whole effort to understand it all the way. Right. So it's kind of flip. And, but like Bitcoin is interesting to me as this digital gold idea. And for anyone that listened to my episode with Mike Green, he very clearly laid out how it's potentially like a very dangerous idea for society, basically, and kind of sort of has to fail at some point. Yet, you know, if I were to show you all my holdings in client portfolios, we own Bitcoin today. And the reason why is, and Mike alludes to it in that same episode, is like it probably goes higher before it goes to eventually zero, so to speak, right? And I think that's where like the institutional risk management overlays come into play, right? Like when do you get off the train, so to speak? You have to be willing to time that. And that's going to probably look like some underperformance in terms of total return. But Bitcoin, because of the inelastic nature of it, has a propensity, I think, to go on some significant runs. And now that it's being offered in spot ETFs and being included in institutional model portfolios and all this stuff, I just think there's flows to it. There's support. There's people are interested in it, and the more people are interested in, the more I think hyperbolic extensions you could potentially get.
But I think that is also the trickiest thing about it, because it's now when I see people adding gold and adding Bitcoin to their portfolio, it's like, I mean, it's been going up for so long, you know. It's like at what point, you know, you have to make that allocation decision, I think, ahead of time instead of just being emotional about it, because I think it is. Well, you know, situations like this, it's easy to get carried away with it.
I think for the clients that you serve, I think that's probably the most prudent way to do it, right? I'm going to buy in here. I'm just going to hold it for a long-term asset, whatever. Obviously, I'm more of a market timer and a trader mindset. So I do it for clients, right? Where you kind of serve do-it-yourself clients, and I serve the do-it-for-me clients. It's obviously a little bit different perspective, but I think like for me, I look at the gold trade and I'm like, I retweeted or I don't know, reposted on X this morning, like a survey that was like, how much gold allocation you have in your portfolio. Well, like 34% of respondents still said they had zero allocation.
A lot of room to go up.
Yeah. And some people had between like, 1 and 3, and then it was like or 1 and 5, and then between 5 and 10, and then like more than 10. And, so I look at it and go, okay, gold is really inelastic, right? Because people buy it and they hold it. And so if you don't have an incentive to transact constantly, the asset becomes more inelastic and thus is like, can get stretched further. And, for any of those that follow the passive work, like that's essentially what's happening with index funds, and causing this sort of this unexplainable phenomenon. People think of like, why are valuations getting so stretched in companies? It's because of just the inelastic nature of this buy and hold mentality that people have learned with the dissemination of information and education, right? Historically, buy and hold has been your friend, right? And for a lot of people, it probably will remain to be your friend, but it can distort things. And I think gold can experience that. But as you have large institutional banks all of a sudden come and say, hey, most people are at zero, there's a finite supply of gold, and now we recommend people have 20% allocation. I think that has the potential to come in and make gold get hyperbolic, probably to the upside at some point. That's just my forecast, and I could be dead wrong in that. But from a trading perspective, right, like you want to look at and have that contrarian take. And so what's hard is to your point, it's already gone up so much, and at some point it has to stop, right? But there's this old saying like, every stock that's gone up 500%, like they have one thing in common. What is it?
Well, they get, yeah.
It's like they all went up 400. They all went up 400% first.
Yeah.
It's like they all went up 100% first. They all doubled first. It's like, so at what point does it go?
I think it does come back to, you do have to know yourself and what kind of investment style that you're going after. And I think when I started learning about investments, I would listen to Jim Cramer, and I know that people will scoff at that, but it was an accessible thing at the time, but one of the things he would say is don't turn a trade into an investment and vice versa. And you have to know what your plan is going into it. So,
well, I always think
as long as people have that penciled out, then
I always think about that because people say like, well, where should I invest my money today? Like, and I'm like, well, are you investing or are you trading? Like I largely do a lot of trading and not as much in investing. And the difference is like in investing, for me, investing is like something you're like, I'm not even going to look at it for 10 years. Right? Like, listen, if you're willing to change your allocations, you're willing to change your mind and be honest with yourself as an investor. If you're like, if this goes through a rough period of 3 years, like you're probably not investing, you're probably still trading. If you're like, if this goes through a rough period for 3 years, I might change my mind and do something different. And everyone says, oh, I'm a long-term investor. But what I see, because I serve the do it for you clients and I deal with this audience generally, is what I find is it generally takes 2 to 3 quarters of underperformance. Yeah. 2 to 3 quarters of something being not meeting sort of expectations, and people start having significant questions and wanting to change this out of the portfolio.
And that's what Einhorn said in his podcast with O'Shaughnessy. He was like, one of the things I've learned over the years working with limited partners is no one is going to come to you and say, I'm a short-term fickle investor. They just, everyone's always in it for the right reasons and in it for long-term permanent capital compounding. But it's a lot different when you're going through it and have to make those tough decisions.
Totally. It's like, that's what I always say about like businesses that are like, when they're like, what sets you apart? And they're like, we really want to take a good job of people and deliver great value. And I'm like, yeah, because there's businesses out there that say like, we're here to rip everyone off and take advantage. It's like, well, of course that's like what you're going to say. It's like it's like, come on. Yeah. So it's one thing to say, start in the right intentions. It's different to live it once you're living it. Right. But I think with like gold and hard assets in particular, like there will be a point I think where it runs its course. And I don't know if that's, this month or this decade or not, right? It could be a very long secular thing. I don't know. But what I do think is trying to maintain a contrarian mindset. And so right now, when I look at positioning, like I've been allocated to equities. And, there's a lot of talk in the RIA space about like, man, like this market's a bubble, this market's overdone, the market's gone up so fast, the recovery's been crazy. And I'm like, but if you look at the positioning data, people are largely not exposed. Like there's not a lot of heavy allocation. Like most investment advisors across the country are actually underallocated on equities. And hedge funds are massively short equities. Well, like at some point, if they don't go down, the short sellers have to become buyers. They have to, right?
Yeah.
And
get squeezed.
They get squeezed, and then all that does is then you have the next step, which is people window dressing the portfolios on the advisory side, and setting up their allocations for next year. Like, oh, well, we're going to get back on this. Everything's fine now, so we're going to be allocated. Like, we're going to have these great returns next year, and so they become buyers. And what you want to probably look for is, and this goes into like the Howard Marks kind of works, right? It's like you look for that euphoria where people are like, oh, actually, the market's not ever going to go down. Close the short positions. Market's not ever going to go down. Get back in. Market's not ever going to go down. This thing has legs. This thing's just going forever. It's like, and that's probably the time you want to get off the bus a little bit, or you start adjusting what your risk parameters are, and like however you approach your portfolio management. That's where you want to start having that contrarian take and saying like, I don't think it does, right? Like, I don't think it just goes forever, without a serious correction. And I think gold is no different, right? Like it will run its course at some point and then be way overextended. And the indications of that, like, are probably not much different than what Howard Marks lays out for stocks, right? When you're at the barbecue and everyone's bragging about how they own so much gold and they're buying more gold,
Personally, I haven't encountered a lot of people that are in that euphoria stage yet. I don't know if it's different, based on, but
that's a sign.
Like, how much further can this go? Just based on just the tariff stuff and the spring and how fast it's come back. I'm finding people are more cautious right now.
But as a contrarian, that can make you bullish.
Yeah.
That can make you,
because there's a lot more
that can
money
mean
to be allocated to that.
There's
sector,
more upside. Hey, it's no secret to us. We look at the demographics of this show. We know that a lot of you listening are actually other financial professionals and other investment advisors. We want to go ahead and invite you. If you're looking to do something different in your career, go ahead and reach out. We're always looking to bring on high quality people that understand how to do the planning process, align with our values, and are looking to deliver high value to their clients. Please just go ahead and reach out to us. You can get us on our website, ducharmewealth.com, and we look forward to talking to you. This is where you have to be a long-term investor. And I think this is where people that lean really heavily on index funds miss the nuance, right? Because it's so easy from an intellectual perspective. And I think it's intellectually largely deficient to just say, I will invest my money in S&P 500. I'm an investor. I'm going to buy and hold S&P 500. I'll do that forever. Or, a lot of these index funds anyways, I come across them. Like, I just own index funds. And I actually really like trading index funds, right?
Yep.
But I don't invest in index funds the same way. And the reason why is because when you look at 10 plus years, I have no indication to feel very confident that that's going to produce a meaningful return, right? Now, it could produce a really meaningful return for 8 years. And then years 9 and 10 are just horrific.
That was one of the things that Howard talked about in his memo. He was like, when I look at my clients, who's in the top decile of their peer group, it wasn't who he thought it was going to be.
Yeah.
Because he thought it was going to be, okay, the people that are earning the awards every year at the dinners, they're going to be at the top of that list. And then he compared it to his favorite restaurant in New York. He was like, just the investors who are consistently good, not occasionally great, are actually the ones that end up on top and with the most money and the highest returns, because they never had that bomb year that just took all that capital and permanently lost it. And it was like, he was like, yeah, just compare it to a restaurant that you like to go to. If they have horrible food one time or service, you're not going to go back. So, yeah, I think it's consistency is probably more important than trying to earn the highest returns.
Well, it's both, right? But it's in the right context. So highest return over a full investment cycle is different than highest return this year or highest return, if we look at what gave the highest return over the last 10 years, the last 15 years. And so I think that's like where people just miss the opportunity to have a real conversation with themselves and say, am I investing or am I trading? And if you're trading, then, like ride the wave on the index funds, like by all means. But if you're married to that position and you're like, it might go down, but it will always come back. Yeah, it probably will. But like, will it produce a meaningful return relative to other things? And look, I'm not a factor guy, but if you look at like small cap factor, right? Like small cap value.
Oh yeah. It's like, been dead for years and years.
But like at what point does it have the outperformance? And the question that I sort of ask is like, is it truly that small cap value hasn't worked, or has small cap value actually produced the real return it should, and everything else is running way hot? And what you have to ask, if that's your framework, or that's your the question you're asking, is the follow-up question is, does the overheated things, does things like S&P 500 eventually mean revert and thus underperform small cap value, right? And so you might go through 5, 8, 10 years of small cap value underperforming, you're looking bad. You're like, man, everyone else is making, 15, 20%, and I'm making, 10 or 11, man, I'm underperforming. But again, if small cap value doesn't get annihilated and runs for a period of a couple of years because it's producing endogenous returns for you from the cash flows of these small companies, and produces that value, well, S&P 500 gets annihilated at some point. Then,
I feel like
all of a sudden you outperform, but you have to have potentially a 20-year time horizon, right?
But that feeling that you outlined, that exact point of, oh wow, this is really bad. Was this even worth pursuing? Yeah. That feeling of capitulation is usually right before you get a big lump of returns scooped your way. And it's like, oh, thank you. I just got paid for all that suffering that I went through. We saw that after the pandemic with small cap value. And it just feels like sometimes returns in the market can be lumpy like that. And if you're not in it, then you can miss it pretty easily, or make a mistake.
You got to stay allocated to your thesis, right? Like the allocations can change
no matter what your strategy is.
Like, you gotta just be doing something, and
then too, just understand, hey, what am I getting paid for? What is the risk here? And one of the things when I looked at the doc and saw Ponzi scheme, it kind of made me chuckle a little bit, because I was like, I kind of went the other way on, actual like Ponzi schemes that you see in the news, and a couple of them that hit home. One is just timely because of the, I don't know if you saw the announcement that the Ty Lopez thing, the SEC got him. They said he stole $120 million.
Yeah. I'm from Utah, where there's so many Ponzi scams and schemes all the time, taking advantage of good people that just, want something a little better out of life. That I'm almost like numb to true, actual, like legitimate illegal Ponzi schemes. I'm just like, yeah, well, that was pretty obvious. I don't know why you didn't see that coming, but people are so good natured that they do fall for it.
I mean that one was particularly, just him documenting everything on YouTube and showing the world like, oh, here's my Lamborghini in my garage. Give me money. It's like, well, should we really have fallen for that? But then there was another one in my home state of Nebraska. This guy, he got local banks for just shy of $50 million. Real estate developer.
Dude, banks. Like sophisticated banks.
Banks. There was, with hundreds of millions of dollars in their portfolio, they know this guy. But yeah, same kind of warning signs: luxury, lifestyle, vehicles, travel, private planes. But still, even the most sophisticated investors can fall for this sort of thing. And it was a really sad story, actually. I think
the allure of returns.
Yeah.
What's the old like JP Morgan quote? It's like, nothing drives a man crazier than seeing his neighbor get rich.
Probably so.
It's like something like that. And I just think that is so true, because it's what takes somebody from saying, I'm making good, prudent, reasonable investments, and I should be, like if you think through all the economics of how returns are produced, where you're collecting risk premium, the extent to which you can collect risk premium, like pretty aggressive investors should be able to say, like, all else being equal, like 8% is a pretty good return, right? Like, but then it's so hard to say, well, I'm just doing the prudent thing. I'm expecting to make 7-8% a year, and that's really great. But my neighbor just won't stop talking about how he made 22% in the S&P last year or whatever, right? And so I got to abandon what I'm doing. And that's usually the sign of like, he pulled forward some returns to the present. You might give them back in the future, right? And if you're in the business of market timing, you're in the business of trading, then, make those decisions, I suppose. But if you're a long-term investor, like, stay the course and do the reasonable thing. And I remind people when we start talking about Ponzi's or I hear so many things, it being like, I don't know, for whatever reason, like Utah is just a hotbed for this stuff. But I always tell people like, hey, so they'll say like, oh, there's this investment and this guy, he makes his investors, 2% a month or 3% a month. And I'm like, and that's
sure
okay. That should be good. Right. Like, and they're like, like, oh, I'd be super happy with that. And I'm like, so, have you ever heard of a guy, Bernie Madoff? And like, yeah, I heard Bernie Madoff, and I'm like, do you realize that to gather billions of dollars from the most sophisticated, like some of the most sophisticated people in the world, he literally was telling people he'd do an 8% return a year. Like 8% linear, like low volatility was enough to be a wild Ponzi. Right. So, and like, he obviously couldn't sustain that with like any kind of real investment, just like 8%
The size of that
right?
crime,
Like,
though, is just astounding.
Oh,
I mean, I think that was like, it was $50 or $60 billion, I think.
Yeah, but
lost.
Right. But like, to my point though, it's like, he wasn't raising capital like that by telling people like, oh, I'll do like 35% a year. It's like, people were like, oh man, like you could just do 8%, like not correlated. Then that's awesome. Like, that's incredible. So here's the big red flag when somebody's like, we're going to do 15% a month for you or something. It's like, dude, it doesn't mathematically work. Right. Like I heard recently of and sometimes it's not even a Ponzi. Sometimes it's just like, dude, you don't understand the risk you're taking, right? Like, it's worked out thus far, but you do not understand how this works. There's actually a hedge fund that's run locally I had heard about, and they promise people something like, they say like, they're not promising, but asterisk, this is what we've done for the last 3 years or whatever, and it's like a monthly distribution of like 4 or 5% or something, without a degradation to the NAV of the fund. And I'm like, and I had run into somebody that was associated with this fund or whatever, and they said, yeah, there's a singular guy, and he's trading options, day trading options, and it's producing, so like they've been doing the last couple of years, like 50-60% a year. And I'm like, that's really cool. Like, I hope it works out for everyone. Like, I want to see people win, but mathematically, to keep up trading options through solely one person's instinct as a trader, as a long-term investment, is wild. And the probability, like the amount of leverage that they're likely taking on to produce that kind of return in the options market, is exposing them likely to the tail risk that the entire thing blows up. Like, now that doesn't make it a bad, well, it's like, it doesn't make it a bad thing, right? Like, there's not like,
you just have to understand that that's a risk you're taking. It's like, I'm actually could lose 100% of my capital I put into this thing, rather than, oh wow, I'm getting 4% a month. Let me put my emergency fund in there.
Well, like, and options expire, and if you don't strike them, they expire worthless. So like, just realize you're taking the risk that the guy goes out for a morning coffee, dies in a car accident on the way home. And, since the trader died and no one knew and couldn't unwind the positions, the options expire worthless, and you lose all your money just from that, right? It had nothing to do with the market. Like, that's a tail risk that no one is taking into consideration. And I've had multiple people approach me about this, fund and talk to me about it. And I'm like, look, if you have $10 million and you want to slide $100,000 over into something like that, like, be my guest, like, see how it goes. I hope it works out for you. But like, hey, if you have $300,000 in your IRA and you're going to try to do a self-directed IRA and invest all your money in this thing, and, try to double your money in the next 2 years so that you can get back on track for retirement, like, I hope it works out for you. But, seriously, are we making, is that really what you want to do? Is that being a prudent investor? And,
it's a quick way to get further behind, in my experience, is people are reaching for returns like that. But I think a version of that is sweeping through the industry right now. And I put it in the doc. It was this article by Swedrow on boomer candy. And that, I mean, I don't even like saying that because it's kind of a derogatory thing to say, but Larry is in his 70s, so he can say it.
Sure.
But just this idea that you have a buffered ETF, you take a big chunk of the capital and put it in a money market fund, and then buy a call spread on the S&P 500 or whatever market you want to use. And then you've got this defined outcome. It's either the option's going to expire worthless and we're going to lose 5%, or the market's going to go up and our upside's going to be capped, but it's going to be okay because we're going to earn that spread over and above on the price return.
Yeah.
And that is just becoming so popular, and people are thinking it's income. And I'm seeing even people come into me that have a big chunk of money in there thinking, oh, it's just like an income fund. It's like, I mean, there's a lot of issues with it, but I don't think people are fully appreciating just how changing that return profile on those investments, you're basically turning it into a corporate bond rather than taking equity risk. So maybe it's better that you're maybe taking a little bit less risk than you think, more. But still, I think people misunderstand those so much.
I completely agree that people misunderstand them, and I will speak from a position of I utilize buffered products and hedge products and all this stuff, and have clients allocated that, and have done a lot of thought work behind this, and understand at a pretty good level how these function and operate actually in the options market, and actually to the extent the effect that this trend is actually having on the overall market because of the suppression of volatility from all these options selling. It will go back to my conversation, and I don't know if you listened to my episode a couple episodes back when I talked about risk and like what is risk, and like I view risk as the framework, right? That risk is like energy. You can't create it. You can't destroy it. You can only convert it, right? So you always have the net same amount of risk. It's just what risks are you willing to take on? And by typically hedging off or eliminating a risk or minimizing a risk, you're adding kind of an equal amount of a different type of risk. So buffered ETFs, for example, if you look at it and you say, okay, I'm going to use like a standard buffer ETF, which gives you a target outcome period of like 1 year. And generally you can get something like a 15 to 17% upside capture on something like the S&P 500. And you get something like a 10% downside buffer. Right. And so when the market's up, you actually do quite a bit better than corporate bonds. Right. And when the market's down, you generally are going to do just fine. And you're typically reinvesting at a period when the market's down. So, you know, you're all else being equal, you're okay. What you're doing is minimizing the volatility of that profile of that portfolio. And if you're in a specific trade, like rather than like a laddered product, you are tightening up essentially the standard deviation of outcomes because there's these more definable outcomes on the whole portfolio, right? The problem becomes that people aren't appreciating is you completely take that endogenous return profile that we talked about earlier, right? Hey, a bond contractually gives me an income, right? The return derived of this investment has nothing to do with whether or not the company makes money per se, or it does a better product, or the economy, you know, goes better, or is somebody willing to buy my bonds for more in the future? Like those can be tailwinds or beneficiaries, right? Like the interest rate environment, but holding a bond to maturity, right? Like the cash flows are contractual in the contract. And so you can measure that endogenous return profile. The return comes from within the contract. When you go to a buffered ETF, because you say, I don't like bonds here, so I'm going to use buffered ETFs because it's this lower volatility than being in the stock market. It's got tax efficiency. It's got these other features. That's great. The risk the thing you have eliminated though, is that endogenous return profile. And the risk you've taken on is that Ponzi-like finance risk, right? That if the S&P stops going up, there is nothing to give you income and sort of carry you through. So the interesting dynamic that you have to weigh out is typically the person reaching for that and we're using the term, boomer candy here, is the same person that probably should be looking at adding some income to their portfolio to fund their more current liabilities. And if you're saying, well, I don't need income because this is stuff for 5 or 10 years off, well, then maybe you also don't need the buffered product, and
but
so,
I think that's where I'm seeing the disconnect is people think it's this magic bullet and then they load up their portfolio, but it's either not matching the timeline, like you say, or they just think it's something that it's not.
Well, I think
people that don't have the guidance on it are falling into that trap.
Big time. I'm a fan of hedged equity for, lower risk people, but at the same time, you also have to look at it and, as advisors, like, we always have this interesting dynamic where, what maybe works best mathematically and what you think is going to be the best on a spreadsheet, so to speak, is not what's best for the client, because the client has to feel comfortable and stay the course. And so that's
where the biggest blowups are going to happen. It doesn't matter what you invest in. If you switch your strategy at when it's not working, you're going to do that with any strategy, and you're never going to earn returns in any market.
Well, Zach, like you're a CFA, so I think you'll appreciate this. It's like, if you look at most hedge equity products and you look at it and you say, okay, they're because of the hedging nature of them, they have this limited upside and they have this limited downside. But what you end up with is a half beta, if it's a S&P 500 hedge product, half beta to S&P 500, which means it moves half as much as the S&P 500. Mm-hmm. Half on the upside and half on the downside, because typically when you dig into those funds, the upside downside capture is all of a sudden not like, well, you get 70% of the upside capture and you get, 60% of the downside capture. Like, there's not a skew. It's like, hey, you get half the upside capture, or you get 52% of the upside capture, you get 48% of the downside capture or something. It's like pretty tight. And those numbers generally don't deviate too far. And you're looking for one, if you are doing due diligence on ones, you're looking for one to obviously make that the most favorable, because otherwise what you can do, if you're like a fee conscious person, or you're worried about, timing the market with the underlying options or whatever it is, you could just buy half the allocate, so like you're somebody that wanted half your money in the stock market. Well, just buy 25% of your money in the stock market and put 25% in money market, and you end up with the same thing on a net portfolio basis, right?
Yeah.
But what I found is behaviorally what happens is you get into the tough market and they see that all of a sudden investors have a tendency to look at the line items, right? And they say, man, my S&P portfolio is down so much. Like, this is just going to go to zero. I have to sell.
We just need to buy a little bit more, actually.
Yeah,
so
totally. Like,
rebalance.
Right. But they're not in the framework of like, oh, hey, this has a bunch of protection built in. I'm going to be okay.
Yeah.
And they can't, it's tough for somebody that is not an investor, right, to zoom out and say, hey, my total portfolio is doing just fine. I've got this, money market or T-bills or whatever. And so as the market drops, like, man, like, well, just, hey, let me rebalance here. Let me be opportunistic. Let me dump a little bit more in. They tend to just be like, this is exactly what I didn't want. The market's down and I'm losing all this money, because they're like looking at the one position rather than the total portfolio. And so for people that have that propensity behaviorally, and I think it's always great as investors to be honest with ourselves and have those moments of self-reflection, then maybe there is a slight drag because of a higher fee or options pricing. But just buy the hedge product if that's what you need.
I think that's spot on. And I think I don't know that that's so unique to people that maybe aren't super familiar with investments or in the markets a ton. I think that's just human nature. We're risk averse kind of people, and I think it is different to look at your own portfolio versus one that you're managing professionally, just to have that level head. Because when it's your own money, it does feel a little bit different. It's like, oh, should I have that or not? So I totally get that.
Yeah, it's there's a lot of nuances there to unpack, but the hedge product boomer candy thing is interesting, but I think it's largely misunderstood. There's absolutely a use case for it. Yeah. And I'm generally speaking a fan, but again, only just as everything else, right? Like, used correctly. I'm also a big fan of using quite a bit of leverage, but also something that has to be used sized correctly and appropriately, right time, right place sort of thing. You can't just go, you can't just go crazy on leverage. But, I mean, that's sort of all things with investing. There are some products out there that for sure though are patently stupid. Like it's just patently bad. It's like, this is uninvestable.
Well, should we, maybe, I just had one more post on here, Brandon. I don't know if you want to talk about the, maybe more lifestyle, fire posts that I had on here.
Yeah.
Okay. So I came across this post. I was curious to get your input on this just because, I mean, me being in Nebraska, I think this might be a cultural thing. So I wanted to see what things are like for you and the clients that you work with.
Well, I grew up in Wisconsin, so I think I'll actually have a dual perspective here a little bit, right?
Okay. So this post I came across, it was posted in the Reddit section for people that are retiring with $5 million plus. So this guy said, I've always preferred to do things myself, like landscaping, repairs, cooking. I get physical activity from them that I wouldn't get from my job. I know things, I know when things are done right. However, I really want to spend more time doing things with family. My son is 15 months old. How do you know when it's sensible to outsource some of those things that, you could get done fairly affordably, when you do have the level of wealth that you can hire out things like cooking, landscaping, cleaning pretty easily. And I'll share my perspective on this. Here in Nebraska, I think people are very hesitant to do this kind of spending. You actually don't see a whole lot of it. So curious to get your take here. I think this is an area just in terms of like investment, if time is a big chunk of your capital, I think people maybe undervalue their time in this way from just my experience.
Yeah. So I grew up on a farm in Wisconsin, not a huge farm. Like I didn't grow up on a dairy or something, but I grew up on a large piece of property, and grew up with a grandfather that was an investor, and anyone that's listened to the story about Tall Oaks obviously knows that, and what that was sort of like. But we fixed things around there, and we took care of it ourselves, and we did a lot of, like splitting wood ourselves and stacking wood, and fixing tractors ourselves and repairing snow blowers and like all these sorts of things, right? And I think that was like really good work ethic to learn. And as a young adult, I used to do things like change my own oil when I could on a car, right? Like, I used to fix all kinds of stuff around our house that was like, okay, this needs to be fixed, right? This needs to be taken care of. I used to mow my own lawn. I used to do that stuff. And, so obviously in Wisconsin, I think like there's this huge cultural thing in the Midwest, right? Like this idea of prudence and, hey, I can do that myself. I should do it myself. And I think there's a lot of value in that, especially actually if you have young kids. I think like teaching them that you need to work hard, right? And you need to assign value to things and know how to be self-sufficient, right? But in Utah, I used to do those things, and I had a mentor a couple of years ago that said like, you need to identify what your worth is and have a kind of a line in the sand, right? Like you need to protect your time because you're somebody that has a skill set and you do important things and you do meaningful work, and you need to leverage that as much as you can. And so for me, like the line in the sand was $150 an hour, right? If I can hire it for less than $150 an hour, I'm not going to do it. And so I no longer personally, like I don't mow my own lawn. I don't fix most things around my house. It's like, not because I can't, it's on the house. It's particularly because I can make things work. I usually can't make them look good. Like that's
more than I can say.
That's a Midwestern farm boy to me. Yeah, I can fix most things. I just can't they usually don't make, I'm not a finished carpenter. We'll just say that, like, I can hang a shelf. I can make anything, I can screw two boards together. It will not look pretty. But like, I don't, I've had my office painted. I didn't paint it myself. I hired somebody. I hire somebody to do like largely as much as I possibly can. Because like $150 is my absolute line in the sand personally, at the current moment. And, the reason I do that is because for me, like, and just like this guy said, like, hey, I have small kids, right? My son is, basically 4, my daughter's a year and a half old. And, if I have time outside of the office, like I want to spend it with them, right? I don't want to spend my Saturday mowing the lawn, right? I don't want to spend my Saturday changing the oil on my car. I'd rather just hire it out and spend that little bit of marginal time at the office, because if I can, like when I do hourly engagements for clients, normally we're at $300 an hour. If I can pay somebody $150 an hour to change my oil, I don't even think I pay that much. But like I could theoretically spend 30 minutes at the office to pay for that.
Mm-hmm.
And if I did it myself at home, it's probably an hour-long project at least. So I can marginally get an extra 30 minutes of time with my family. And I'm in the phase of life and in the position that's just sort of the way that I think about it. Now, at the same time, right, and this goes back to the cultural thing of the Midwest, I think there's a ton of value in what my parents taught me as a kid, in being self-reliant, looking out for yourself, taking care of your things. And so as my kids get older, I may change that and be very intentional about showing my kid how to cut the grass. And being that being that
but
example.
Just that decision though, to say, I could outsource this, or I choose to do this, versus, I just have to do it out of habit or obligation.
But I think
I think that's the important thing though.
Yeah. It's making a conscious decision. Am I doing this out of a financial decision, or am I doing this out of a values-based decision because I want to, and particularly I think, like for me, a value-based decision around teaching my kids a certain principle.
Yeah.
Right.
I came across this, he's a retired guy. He did retirement pretty early. I think he retired when he was 55. He's in Ohio. This guy, Joe Kuhn, he's got a YouTube channel. He's got a ton of subscribers, but he talked about this. He's one of these guys. I think he's certainly maybe not in this chubby fire category, but certainly millions of dollars. But he'll hire people to cut down trees and do stuff around the house that he's like, I'm an engineer. I worked in a factory. I should be doing these things, but he's like, if I fall off this ladder and I break my leg, like that's a huge risk, because he's early on in retirement. If you have to spend a year or two getting back to full strength at that critical time, it almost kind of reminds me of that bond tent strategy where you're like, I'm not going to be able to go on that trip if my leg is broken or I can't get around. So I think that's valuable to think about as well.
Yeah. I think about, this is like really almost unrelated the more I think about it, but what popped in my head was my grandparents had this huge trip planned. They had sort of like put it off till the timing was right. And then they were on a wait list for like a really long time. And it was this huge cruise. They love cruises. And it was this huge cruise, and it was like down to Australia and all through like the Indo-Pacific. And it was supposed to be like, I think like a 4-month cruise. And they waited like years to get, it was like a waiting list. They were like years in the making. And, literally within a couple of weeks of leaving on the cruise, my grandpa ended up getting Bell's palsy, and like they couldn't go. Mm-hmm. And that event actually probably, in hindsight, was probably the beginning of my grandpa's health in general deteriorating, and probably going from the go-go years of retirement to the slow-go years of retirement. Right. Yeah. And then quickly, that was the slow-go years. And then it was about 8 years after that he hit the no-go phase, and so he never got that to happen. And while that's different than, falling and breaking your leg, it's just, I think there is something to be said about thinking about things a little bit different and saying, what could possibly inhibit my ability to, really reach my meaningful goals. And if I've planned and designed my life such and such that I retire early in my 40s because I want to go do all these meaningful things, then like maybe part of that plan needs to be able to say, I also want to not do high risk activities that could prevent that. And I got to budget and build into my plan the ability to hire those things out. Yeah. That's a really interesting perspective.
Yeah, for sure.
Such a cultural difference though, for sure. But yeah.
One time, just to put a closing point on that, I saw a client at a restaurant, and it was this new burger place that opened up, and this guy, he was worth like $10 million, and they were doing buy one, get one free burgers. And we stood in this line for like 90 minutes, and he saved $10 on a burger. I was like, wow, that was Probably not a good use of your time,
Well,
but you can make that decision. But I've never forgot that. I was like, gosh, that was stupid for you to do that.
okay. I'm going to look, just for the sake of interesting argument here, I'm going to like defend the guy's point, right? So if you have like $10 million and you have like nothing more meaningful to do in the day, then there's nothing wrong with like waiting in line for like buy one, get one free hamburger. If you're like, dude, I want a hamburger today. And I don't know this guy, I have no idea who he is, but he's like, I wouldn't mind standing in a line today because I have 90 minutes worth of things that I want to think about in my head.
Yeah.
I'll just do it waiting in line for a free buy one, get one free cheeseburger. Like, then that would be, I'm not saying that's what happened. I'm just saying like that would make it a sort of a valid decision, right? Like, listen, I have a guilty pleasure of McDonald's, right? I like McDonald's.
Oh my gosh.
But like
Big Mac.
Look, yeah, I'm not a Big Mac guy. You want to know why I'm not a Big Mac guy?
You're not a Big Mac guy?
I'm not a Big Mac guy. I'm not
What's
even
your order?
My order is usually whatever I can get a really good deal on with the app.
On the app.
On the app.
That's probably the biggest takeaway is if you don't have the app downloaded, download the app because you'll save 20-30%.
We're gonna be fine. We're gonna have all kinds of the fire subscribers now. But like I've joked about this all the time. There's nothing wrong with like being frugal, right? Like there's nothing wrong with paying attention to your resources. Like being wealthy doesn't just mean like, oh, I just spend money and whatever I want, whenever I want, no matter what. It's like I think when people can change their paradigm shift to think about wealth a different way as wealth is a lifestyle. Wealth is the ability, but not necessarily the unsatiable desire, right? Like it changes, right? And so like all being equal, like do I have the resources to go to McDonald's after this and buy anything on the menu I want and not have it impact my life whatsoever? Yeah, I do. Right. Like humble brag there, I've got $12 in my account, but it's like, I think that's what a value meal costs if you just like order it regular cost now. I don't know, because guess what? When I go to McDonald's, my order seems to be like between $4 and $6, and that's because I use the app, and it's because I want McDonald's. But it's a habit that I was raised with. Like, dude, my like I was raised in a family that we had resources, right? I was raised in a family that also my mom was an aggressive couponer. So it's like behaviorally, I'm like, oh, like I've got coupons in my car right now for like Ace Hardware because they sent me some coupons in the mail that's like $5 off your next purchase, and I'm like, well, I needed to get a key made. And I happen to know they cost like $5.25 now. So I'm like, cool. They just sent me a coupon to get my key made for 25 cents. I will put that in my car and I will stop by Ace Hardware to get the key made, like when I've got a minute. And I don't think there's nothing wrong with that mindset. Right. And I'm sort of defending myself here, obviously, but at the same time, I'm also willing to go out and say like, I hired somebody 2 weeks ago to bring salt to my house and fill my water softener for me because I didn't like have time to stop and pick up a couple bags, didn't really care to like share my back, and it needed to be done, like,
well, I think it's just about that intention.
That's what it comes down to, I suppose, is the intention. I refuse to give credit to the person that probably deserves credit on being intentional about spending, but I think this is an appropriate way to think about it.
Yeah. Awesome, Brandon. I think we definitely got my 3 covered that I put in the doc. So I don't know if there's anything else that
I think
we need for your production so.
I think Zach, I appreciate you taking time. You're a stud, dude.
Thanks so much. Yeah. For having me on your show.
There is always so much to talk about when somebody is willing to be a critical thinker, open and honest, and, give stuff an intellectual thought. Like there's so much content that gets put out these days, and it's just so much of it has like an ulterior agenda or motive. And like, candidly, like the underlying motive of this podcast is like, we want to be out there so that people can find us and work with, more and better clients. But, like our main focus is just trying to give people education, insight, and stuff to think about. And that can be tough. So, hopefully people find this and find it interesting, but I think there's still like so many things that we can talk about and probably have you back on to do more episodes.
Well, I would be open to that anytime. Yeah. I love hanging out and chatting with you. So yeah, anytime that it makes sense for you, would love to do it. I appreciate that.
Yeah. So, Zach, for anyone still listening, really quick, we touch on this in the episode. So I obviously serve people that are primarily more of the do it for me clients. We manage their portfolios for them and we handle stuff more hands on. Zach actually only exclusively works on an hourly basis for clients. Correct, Zach? Yep. And so he doesn't do any of the do it for you. He helps and supports the do it yourselfers, if you will, and gives them guidance. So it's a little bit different of a approach and angle on stuff. But Zach, I think it's totally fair. If somebody's interested in getting your perspective, as if they're a DIY investor and they want your take, where'd somebody find you?
Yeah, they can check out my YouTube channel. It's just my name, or my firm is called Barrett FP. You can find us online.
Cool. Well, I appreciate it, and we will almost certainly have you back on in the future again, Zach.
All right. Thanks, Brandon.